Welcome to the Broken Pie Chart Podcast, episode 281. I'm your host, Derek Moore. Back with me once again, reunited, is Jay Pestrichelli, Zega Financial. Jay, the audience was offering up Satoshis. I don't know who that is. Is that a meme coin or something?
I got everybody's payments. Thank you. I am back. It's good to be back. Thanks for, I'm happy to take continued funding to show up on this wonderful podcast that I love being a part of.
For the regulators, that is a total fictitious statement. We're not taking money.
Where'd that money come from? I don't know.
Well, while you were gone, a few things happened, but I will say, why don't we start with this? The Fed, well, I would say the expectations for Fed rate cuts. Remember, we look at the CME Fed probability rate information. We look at implied rates on Bloomberg. Let me just remind everybody why you shouldn't necessarily hang your hat on it. Hang your hat on, or whatever it is, the phrase that we need to use here. The end of 2023, December 29th, the implied Fed funds futures rate was 7 cuts. It said by January 29th, 2025, the rate would be 3.6, the implied rate.
I know. I remember that. And I remember shortly after, Derek, I wished we could have taken the other side of that, because I don't think you and I at any point thought 7 was a reality for 2024.
Let me ask you this. Now, and this will be wrong next week. I shouldn't say it's wrong. This is what the market is feeling right now. Remember, we were 1 cut. Oh, no. Now, by January 29th, we are pricing in 3 rate cuts. So come back in a week, 2 weeks, a month, and this will say something else. But I don't know. I mean,
so what changed, right? A couple of things changed. We had another tick up in unemployment a few weeks ago. I missed that podcast. My apologies.
You did.
But we also had a really strong CPI number this past week. And so, right, so the idea there is, well, the Fed has said now they're going to watch the labor force with equal amount of vigilance that they're, whatever that means, of the watching the inflation rate. And so if inflation's coming down and unemployment is going up, I guess the reaction here with the market is like, oh, they'll have to cut because CPI will allow it. Inflation will allow a cut, right? It won't spur, inflation again, because you don't want to get too far behind on the unemployment number and then have to dig yourself out of a deeper recession, right? I mean, that to me are the 2 factors the Fed has said matter, and the market seems to be reacting that way. I don't know, right or wrong, like you said, it'll probably change next week. Seems like a lot to me to change on 1 month, to pivot this badly.
I want to come back to something about playing the other side in a second, but first I want to explore this idea that all of a sudden something has changed.
Yeah.
All right. I looked at you always make fun of me when the numbers come out. I go and read a 5-page PDF while everyone else is talking about the headline number. I'm looking in the details. There's 2 things. A lot of the shelter actually went up in the CPI. Most of the CPI's lowering, and the fact that it was negative because gasoline prices. Those, I believe, are up in July. So remember, that was a June number. The thing I'll say about unemployment is, from what I can tell, a lot of this, remember, it's what's the size of the population, what is the size of the working age population, and then that population is made up of people who are working or actively looking for work. And what we've seen, or at least I've been seeing, is a lot of people are coming into the working age population. And I don't know if it's just people coming off the sidelines, or I'm just going to say it. I mean, we've talked about this in the past on the podcast. There's a lot of migration right now. And the BLS has said they don't make any judgments or differentiation between who is in the labor force. So I could make the argument, and I full well might be wrong, that we're seeing this uptick in the size of the working age population that is looking for work, and that's what's causing the uptick. But on inflation, I mean, on CPI, shelter went up. Really? Shelter went up. So
It's
I
a
don't
big
know.
portion. Yeah, I'm missing you. So yes, I do always like to make fun of you that you spend a lot of time reading that, but I do miss that. I thought maybe it'd be in the notes for this week that what was it, the super CPI, the numbers that we've dug into in the past to look at those different pieces. Hearing that shelter went up doesn't surprise me. I wonder though, as rates come down, if it'll be kind of a little self-fulfilling prophecy there, which we thought the other way as well, right? Remember, we had always said raising rates was actually inflationary on, cost of living, housing, shelter. So we'll see if that kind of unwinds itself at the same time, Derek. What kind of hurt it could help it at the same time.
By the way, Supercore, since you mentioned it, was 4.8% last month. This month, it came down to 4.65% year over year. Supercore is X energy, X shelter, X food. So everything else still 4.6% up year over year. All right. The other thing I'll say on this is everyone is talking about, and I feel like we're starting to show our age because we lived through periods when we had higher Fed funds rate and lower inflation. And I hear a lot of people, and I'm just going to say it. I think it's misinformed to say that, well, if inflation gets down to 2%, the Fed funds has to be 2%. I look back 93 to 2000. And if you look at the Fed funds rate, it generally, it ended I believe it was 5.5 towards, or, just over 5 at the end of the decade. But for a lot of the period, Jay, it got over 6. They lowered rates to under, what was it, like 5.25. And then by the end of 98, they brought it down to like 4.75. But that whole time, when you think about inflation, inflation was it was below 3% a lot of that time. So the idea that you have to have rates equal inflation is farcical. It totally is.
That's actually, the Fed doesn't even want that.
No.
Right? The Fed absolutely doesn't want that. There is a term that is used that helps you understand that inflation and then the payment on is it the 10-year that they use for this, right? Should be about a 1.5% difference, right? That's kind of what the 1.5 to 2% difference. And maybe that's just because of the duration on the 10-year. That maybe typically adds a little more. It's not when we're inverted. All of those things, Derek, when I think about it, I don't know. I don't think anybody would think if with a target inflation of 2%, we should not expect bonds to be at 2%, right? That's not what the Fed wants, actually.
No, if rates got down, let's say inflation gets down to 2%, and why the 2% target? Give me a couple hours and I'll go after that. But it's all right if it comes down to 2% and we're 2 to 2.25 above that. Or 2.5? What does that mean for a Fed funds rate? 4 to 4.5? We're not going back down to zero anytime soon. We're just not, unless there's some major upset in the markets.
Yeah, you throw a random pandemic in there, fine, but that's the kind of event that it'll take to get us there.
I guess anything that only happens every 100 years is random, right?
It's random.
It's kind of random. But Jay, what happens when? All right, a lot of talk about wait till they cut rates and the market will really run. There's one argument that says the market's already front running this. But Jay, all right, so you've looked at some data recently. What happens after the first rate cut? Is it a good thing? How good?
Yeah. So, generally speaking, Derek, I'm gonna punt back to you on this one because I could make the argument on both sides of this one. Let me kick it back to you first.
All right, let me just set this up. When you look, this goes back to, I think we pulled the data going early 70s. November 19th, 1974. 12 months after the first rate cut, the U.S. total market went up 38.5%. And generally, it's, the median, we go back to 80, 81, 82, 84, 90, 95, 98, 2001, 2007, 2019. The median 12-month return for the market is about 22.1%. When was it negative? Well, January 3rd of 2001. I would argue that I mean, they cut rates. I'm surprised they didn't cut them earlier, but they did cut rates. But we had the tech crash, and then of course you get 9/11 in there. So and then September 18th.
That was after that, but yeah, go ahead.
Yeah, but I mean that's within the 12 months. 12 months later would be
That's true.
1/3 of 02, and then you have September 18th of 2007. They cut rates, and of course 2008 into March of 2009. So I don't know. I mean, it seems like if you look at this, it is positive for the market.
All right, so this is why I have so yes, generally it's positive. I'm going to take this counter position here, which is that the sector that ends up underperforming in those scenarios is, based on the way that all the sectors were organized in the past, seems to be technology, energy, and telecom. And utilities. Let's throw all those. Let's definitely throw telecom and technology together these days. Those sectors underperform everything of the other sectors when there are sell-offs, right? So my thought here is we've had a tech-driven run that's pushed us higher, right? You think about what are the biggest three companies now, Apple, Microsoft, NVIDIA, right? All tech focused. So, part of me thinks that, by the way, there are years where the overall market was up and tech was not. You look at 1990. It's just one of those things, Derek, that, maybe the thing that's driven us right now will be a little underwhelming after the first rate cut.
Okay. Well, wouldn't you say, too, it matters where you are in the cycle? And some people would say, okay, the Fed hasn't really cut rates with markets at all-time highs. I give you 1995. And the other way is, 07, they were cutting because things are falling apart.
Yeah, they had to in 07, right? Of course, that was a dramatic move of the financial system, right? What happened as Lehman went under, right? So those things were, I get why they cut then, and then the market was just reacting to that. To your 95 scenario, market was at the high, still went up 23% a year later after that. Makes sense. Tech was up 14, which is still positive, right? But not like the rest of the market. So maybe it's, I could make the argument that an equal weighted might be better after the first cut versus a traditional index. And I almost never say that, right? I like the way the S&P and the Nasdaq do their weightings. That's my default follow. Maybe after the first cut, you let the other things that have been lagging give themselves a chance to kind of catch up, and maybe those do. So, look, generally, obviously, things are up after the cuts, right? I think that's after the first rate cut. That seems pretty obvious. But just thinking about the cycle that we're in, I'm trying to give you a counter argument.
I like the counter argument. The other counter argument to the Fed doing anything is if they're too dovish, they could create another spike in inflation. Somebody did your favorite thing. The source is, BLS, Apollo chief economist, and Bloomberg. Okay, this is probably an Apollo chart that I found. Yep. So what they did, your favorite thing, Jay, they took 1966 to 1982. They did a chart of the CPI. And then they also started another chart from 2014, overlaid it on top, 2014 to 2030. 2030 hasn't happened yet, but you can see where we are in this cycle. And basically they're saying 2024 is 1976. And what happened in the mid to late 70s is you had inflation come up, peak in 74, come down by 76, and then peak again in 1980. There's some people make the argument, if you lower rates too fast, you get the double peak. I feel like this is fighting yesterday's war, though.
Yeah. By the way, nice work on the creative charting out of Apollo.
Your favorites.
Yeah. Don't worry about the right and left scale matching, and don't worry about the years, but they made it all work out. It's fine. But it is an interesting point, and it is something absolutely that the Fed chair has talked about avoiding, about letting CPI come right back. I think they've reference this exact time period that happened in the 70s in the past, and they don't want that to happen. I think they're going to be pretty vigilant on that. So the only thing this is missing is where, when was the first rate cut, back in the 70s, right? And just to kind of see what happens after that. But look, I think the Fed is really paying attention to this one. You're right. This is a yesterday's discussion. I'm not sure. And it also goes back to what caused the inflation, Derek, right? Supply versus demand, all those kinds of things. I think we had a different reason this time around than back then. But, can I just get back to what if I don't think they're going to actually cut 3 times between now and January?
Yeah, and as we do that too, I'll just tell you my other problem with this chart, and I'll spend 2 seconds on it. They measured inflation differently from 74 to 82. We have owner's equivalent rent now. If Larry Summers put out a paper, if you measured it the same way today as they did in the 70s, we would have had like 20% CPI. All right.
But I wonder if the rate to change, right? They could have just changed the scale on that. But the point is, relative to where it was before.
You hate the charts. You hate the years. You hate when we do that. I know. You don't like it.
Creative, right. Very creative. So what is, this is the thing, like when the market is, can I just rattle off a little what's on the Fed futures? So like when you take a look at the chance now for September, a September cut is 90%. There's a 90% chance that there's one rate cut in September. There's actually a 6% chance there's 2 cuts. So there's only a 4% chance that there is no cut at this point, according to the Fed funds futures. So, by the way, I kind of like September. We've been using September. If there was going to be a cut, that happens around September. Seems like that's falling in line now. But this 56% chance of a cut in November, and then of a second cut, and then another cut in December is also at 50%. Like these 2 numbers were non-existent, the last time we talked about this, right? 3 cuts wasn't even in the market. So if I want the other side of this, Derek, what does this mean, right? So if I think, hey, and I don't want to be a commodity trader, a futures trader, I just want to take the other side of this, saying I think the market's got it backwards. What's a way that I could turn around and, put on a position with, ETFs and stocks that would let me, benefit from, this prediction not holding true?
Okay. I'm thinking we need to find maybe an ETF, Jay.
Yeah, I think, yes, an ETF is the way to go, in my opinion, as well. And look, if we're just going to isolate on treasuries, because that's what the Fed really touches, there are some short-term treasuries, right? BIL, BILS, that have 1 to 3 months, 3 to 12 months. Those might be an interesting way that you could reflect it. However, you want to be on the other side of it, right? So what this means, if rates are going down, those ETFs will go up. So if you don't think rates are going to go down, you want to take the position that bets that the ETF does not go up, right? So you want flat or down exposure. Hard to get that with those ETFs because they're so short term and they have such a high interest payment. So I like the IEI in this situation. By the way, everything we're saying here, right? Use your own research on this. We're not going to give you a straight up trade idea, or maybe an idea, but not a straight up trade. But these are the kinds of things that you and I would look at. And I would say, let's look at what the options are predicting the price of, say, IEI, which is a 3 to 7 year bond, is predicting. So it has some option volume. You do have trades in it. It is not the most actively traded ETF, so trade at your own risk on this one. But I like, when I look at this, it has the break even on that IEI. Looks like it's around just over 118, and it's trading at 116 and a half right now. So, I think it's a bear play on IEI using the futures out to January. That might be the way to trade this.
So let's think about that. So that has a duration. Well, it's 3 to 7 years, right? IEI. So yeah, probably I'd have to look at the modified duration of that, but it's It's not the 20-year or 30-year. It is a shorter duration. So, but if rates are expected to go down, and I think that's already reflected in the price of IEI, it's gone up, meaning.
Oh yeah, IEI had a nice pop the other day, right after CPI. Right, it definitely moved higher. Yes.
So I think it's safe to say if rates didn't come down, if the expectation proves to be false, and they imagine they don't lower rates at all, this thing is going to, maybe go back down. I mean, I'll let you know when I know. But yeah, I mean, I think that's a good, reasonable approximation. AGG was the other one, but there's other things in there. There's corporates and MBS and different stuff in there. So, okay. I mean, yes, you could buy a put on it, although that would be a little bit expensive. You could short it. And again, like Jay said, we're not recommending you do any of this. You probably should just do the opposite, actually. But
right. Hey, look, if there's 5 cuts, that's going to be a bad trade if you take the other way on this.
But look at the options, though. Like, I find it interesting, Jay. It's worth delving into a little bit. The call versus the put price. Like, the call price is telling me that the market expects rates to go down.
Yeah, I mean, there's a little bit of cost to carry in the January options because you've got 6 months of interest if you want to synthetically trade this. However, if you were to look just if you wanted to just trade up like a bear put spread, a debit put spread on this thing, 119s to 112s, that kind of a thing that's equal extrinsic. When I look at that trade itself, if I was to buy the 119 and sell the 112, I think that's what I want to do. It's one of those things that your break even is $2.50, cost you $2.50 below 119. So 119 minus 2.5. Yeah, that's right. It's a zero cost. So that's a way to play this where time decay doesn't hurt you at all, right? It's just a straight up directional play if you did that kind of a, long put, short put kind of a situation. You could do it on the call side, or you could do synthetics, which lately you and I have done a lot of that, which is what you were just talking about, where your break even is something like 118, right? So as long as IEI stays below 118, it ends up being a profitable trade. If it goes above that, now you're losing. So, I think there's a lot of interesting ways. So let's just say bear trade on IEI is the way that we think reflects this this new opinion in the market that there will be 3 cuts.
Yeah, I don't know if it, that's the other part of it, though. There's so many areas in the curve, 20, 10, 20, 30, all this stuff. But the shorter end is most affected by interest rate decisions by the Fed. So, all right. I mean,
there you go. Write that one down. That one seems interesting.
All right. So are we, you and I usually take opposite sides of stuff. So you're saying they don't cut 3 times.
I will take that they don't cut 3 times between now and the January meeting, including the January meeting.
I don't want to take that
listen, you made me take the market will, not go up enough. I think you have to take this side.
All right. They do cut 3 times then. I'm doing a kicking and streaming.
You're 3 or more. At least give me one that we both agree on. Keep losing the other ones.
Well, I did say I took 6,000 by the end of the year. I said the market would get there. You took the other, and you said the VIX may have a 10 handle.
Well, those are the 2 that are left. All the other ones, though, that we made, you won already. So, yes, we still do have those 2.
I win them all, usually.
Yes, and there you go.
If I don't win them, I'll never speak about them
then
again.
We won't bring them up on the podcast again. That is the downside.
That's right.
For me.
I only go over my winners. That's right. I'm like a trade. Like when people first start trading, and they only tell you about their winners.
Oh, I love getting those. Look at these great trades I made. Yep, those are good ones.
Oh, it's fantastic.
We're the bad ones.
Yeah.
The bad ones are always more interesting to me. You know why? It's because how'd you manage the problem, right? How'd you manage your risk? How'd you manage getting out of trouble? That to me is a better illustration of your skill set, because obviously nobody's 100% accurate. So what do you do when something goes wrong? I like that old adage, smooth seas never made a skilled sailor. Yeah. It applies to us every day.
It's when something goes wrong in a trade, which we've had happen, but it's something that goes wrong in a trade in a way that we haven't seen before but you know how to handle it because you understand why it's happening, what's going on with the pricing.
People should email you those examples, Derek. Where would they send those?
Derek.Moore@ZegaInvestments.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to get correctly. That's the best way. And questions and praises, all that type of stuff. By the way, we haven't asked people for a while. Go ahead and give us like 17 stars. Okay, actually, you can only do 5 stars on
5. We'll take 5. That's good.
We'll take 5. If you're not going to do 5, don't bother. We only want the 5s. All right. Here's an interesting thing. I found it interesting anyway. Who is this from? This might be from Bespoke. They did the Nasdaq Composite percent change after major technology releases.
Ooh, okay.
Yeah. So this is... I'll kind of read some of these off. I find this interesting, but I want to focus in on 2, ChatGPT and Netscape. Netscape was December of 94, ChatGPT November of 22. The iPhone was Jan of 07. MySpace, I don't consider MySpace really a technical, maybe it was, 8 of 03. The iPod, 11 of 01. AOL, 2 of 91. Wow, that was early. And MS-DOS, 8 of 81. But I look at ChatGPT and Netscape and I hone in on those. This is another chart that you absolutely hate, but I'm going to go through it anyway because I pulled it and that's what I can do. This is using.
I don't hate this one, by the way. But
you don't, okay?
But I don't hate this one.
It starts every one of these at the date that I just referenced, and then it went out. What is this? 750 days later. So we're not. Yeah, so we're not there yet. And or is this months? Is this months? I don't know. No, that's trading days. Trading days. So
actually it's 3 years, 750 days, 3 years of trading going forward, not calendar days.
That's right, including leap years, including everything else. So ChatGPT is above the pace that Netscape was, but Netscape was the highest return of all these. And I'm going to make the argument that this is a nice correlation because all those other things I think really helped those companies. They helped. I mean, MS-DOS, I'm a little, I don't quite remember that one. But, Netscape is big because what you have is, sure, you have a lot of companies and tech companies that are upstarts. You have a lot of, winners and losers. The standards are set. I'm going back to Technological Revolutions by Carlotta Perez. And then you have these old line companies who adopt the new technology and gain productivity and all sorts of things. And I think ChatGPT could be that way for companies. So, I don't know. I mean, who knows what the Nasdaq is going to do? Good luck trying to, if you think it's going to go up, you buy it. If you don't think it's going to go up, don't buy it. In fact, we would say buy the markets and hedge them and stay invested. But am I wrong on this, Jay?
No, look, I mean, the argument has been made that AI can be bigger than the internet was as far as transformative technology. We've heard that argument a few times now. Every major company is including it in their quarterly press releases. Everybody's figuring out the right way to adopt it. The 2 largest changes, or the 2, let's say, after they were released, the ones that went up that caused the highest movement in the Nasdaq, it seems, I don't say caused, but timed that way. AOL, right? So the masses having access to the internet, and then Netscape as a tool that helps navigate it. It's interesting that they're almost kind of concurrent, Derek, right? You've got AOL that goes from February 91 through, I guess this would be, let's say, February 94. And then Netscape's chart goes from December 94 through, end of 97. So what people can't see here, these are the 2 biggest appreciations on this chart, right? They move up the highest. 3 years after Netscape, as you mentioned, market's up 100 and what's that? Probably 120%. The Nasdaq was up 120%. AOL up about 65, 70%. ChatGPT is ahead of both of them right now. It has been an interesting time period, right? The first, let's call it 400 days. So we're halfway through, says the Nasdaq's up 70%. I don't think there is much of an argument that the driver of the Nasdaq this year has mostly been NVIDIA, and we know NVIDIA is an AI story. So I do think that there is some relevance here. Interesting though, Derek, we trade the actual stock, OpenAI, ticker AI. We trade that. We actually have a fund that trades that, and doesn't see the appreciation that NVIDIA has seen, right? Or other chip makers like SMCI and those types. Like the AI world, right? Interesting enough that AI hasn't seen as much appreciation. But I will go back to your point. I like that you're making this connection that if ChatGPT is going to be transformative, it is on pace as the largest previous technology releases that today are considered absolutely transformative.
By the way, I'll just remind everybody or the audience, Netscape, December of 94. There's that 94, 95. All right. I'm just saying. Going to be wrong on this, by the way.
I think you've been right so far.
Yeah. I'll try and find, I did a whole episode where I think you were off. You were on vacation. This is like a year and a half, 2 years ago, where I sort of just went through like, could this be 94, 95 and the attributes of it? I don't know. All right, Jay, let's transition to earnings. We
are in earnings season. This is always a fun time to watch the market.
Yeah, I think the banks were good. Even Wells Fargo was good, but they didn't like their net interest margins. But this week, I'm just kind of looking at the docket. Goldman Sachs is Monday. One that I'm watching is TSMC. Taiwan Semiconductor is Thursday. Netflix is Thursday after the close. ASML, Schwab is Tuesday. So, but I mean, really, it's this week. It gets going more. I mean, Friday was the banks. This gets going. United Healthcare is. I mean,
that's a biggie. Tuesday. That's on Tuesday.
Yeah, before Morgan Stanley, a couple of those, and then the 2 weeks in the future is really the bulk of it. But I mean, this is the time we get a look. This is kind of an exciting time.
Bang is Thursday with Netflix. They're always kind of first, right? Do they set the tone? That really, Netflix is kind of fallen out of the FANG. Most people don't include it anymore, but it is always kind of the first one that when you look at kind of those big technology companies. Yeah, so it should be an interesting next couple of weeks. It always is around earnings. I wouldn't be surprised to see a little money come off the table, and we've seen that before. We're leading into the kind of the big tech companies announcing, and then it's not typically, but general, I should say this, like we've seen the market kind of appreciates, the next 2 weeks after they're done with their announcements. We've done studies on that. That's probably something we should refresh and share, Derek. So that's a good topic for maybe next week, but just very. I know you said Taiwan Semi. That's obviously a nice leading indicator as well for the semis, but really the U.S. big tech companies next week.
Do you know Taiwan Semi is $1 trillion companies now?
I do know that. I know.
It's kind of like if NVIDIA and AMD and some others are the picks and shovels of AI, Taiwan Semi is the picks and shovels of the picks and shovels.
Right.
They make all their stuff.
The chips, right? Yeah.
They make all their stuff. There was a Piper Jaffray analyst on. I don't watch much CNBC these days, but I don't know why I had it on. And he made the case that inventories are lower. I mean, this is what he said, which is helpful for these semis. But I don't know. I mean, well, semis are pretty sick. They can be sensitive to the economy too, and so we'll see. Anyway, that is coming up. And so far, I mean, the banks exceeded earnings expectations. So, all right, let's talk about options. Did you see IWM call option volume was the highest it's been going back to 2019? And there's a chart here. Is this contracts? Oh, no, this is in thousands, right? So this is 2 million contracts, IWM call volume. Is that right?
That's what the chart says. Yep, that's quite a bit. What drives this kind of a thing, right? So there's been this. So I guess that's where we want to lead to on this. But there's always been this connection, and it hasn't always been true. But this thought that lower rates benefit the small caps better because when they have to refinance their debt, which a lot of them have debt, it'll be cheaper. Right. I think that's probably why the Russell 2000, we call it the RUT, which the IWM is the ETF for that, has been lagging against the other the other major indices because just rates are higher and small caps are going to have a little bit more of a problem. I will tell you the last time that we saw kind of the idea that rates were going to drop, and we talked about this earlier, right? The January time period of 2024, when there was the 6 or 7 prediction, that was the last time you saw a lot of call contracts on IWM as well. So this feels to me like a play on interest rates through small caps, Derek.
Yeah, I agree, and I think it seems like it's the hot trend. Everything is going to they're going to cut 3 times. It's going to help small caps. Small caps have lagged. The relative performance against large caps it's kind of a chasm right now that's open. So yeah, okay, you're a daisy if you get that one right. How's that?
Yeah. I mean, on the day that CPI came out, the the large cap indexes, Nasdaq, S&P, actually ended up being down despite being up right at the open. Not the Russell. Russell's up strong. I think there was a 600 basis point difference on a single day performance. So 6% difference between the Nasdaq and the Russell on that day. So again, people just got bullish the Russell with this idea of interest rates coming. So I guess it's another way to play that. I don't like it as a pure play for interest rates. There's so many other things that can work their way into the Russell. Hey, Roaring Kitty could put out a new tweet, and that could change what the Russell's doing. So there's a lot of ways to play it, but that might be explained why you've seen kind of the excess performance over the last couple of days.
I mentioned on last week's show that implied volatility was on Tesla was going up, even though Tesla was going up a lot. I mean, it went from a 50% IV to 70% IV. Did you see the VIX index? That's not quite as dramatic, but as the market has been going up, if you kind of look at a chart of the VIX and a chart of the S&P 500 index, after June 28th, you sort of had volatility was dropping. Volatility has been going up, mirroring the move up in the market, although it fell off Friday. I mean, do you think this is we're starting to get closer to the election, or I'll call it the shenanigans of whatever's going on with, is Biden going to drop out? Is he going to stay? Do you think it's starting to be forwarded a little bit? Some of that October, November vol?
I mean, maybe. I know a lot of clients that I've spoke to over the last couple of weeks have thought, I'm nervous about the election. My answer is always, that's why we hedge. Don't take yourself, don't put yourself on the sidelines when you've actually got protection on already. It's fine. It's actually worth weathering this if there is even a little volatility when you have a hedge on. Derek, I think it's more, it's a little early, right? It seems like it's a little early right now. I mean, the talk of the current vice president being the nominated, getting the nomination for the Democrats. All right, that's a little interesting. But, I don't know why that would mean market volatility in July and August, right? Because this is the next 30 days. So we're halfway through July. So it captures the rest of July and, the predominant most of August. I in all honesty, Derek, I don't think it has a lot to do with that. I think it's, hey, like volatility is low, put on a hedge for the rest of the year, maybe. And maybe that's the thing that's putting it in there. Maybe some people just feel this market's just overbought, went up too fast. It has moved up fairly quickly, the last 1 or 2 pops that we've seen. How many up days did we have in a row at one point, right before the down day on the CPI day, right?
Well, we haven't had a minus 2% day in 300 days plus or something, trading days?
Right. No, that has, it's been well over that. Which again, I think you probably talked about this. That's not that unusual. That kind of happens. But to see the VIX, move from 12 to 13, I would argue, Derek, that's not a big increase. That seems like normal movement. But you're right. It is going up while the market is going up. It doesn't help my bet that we'll see a 10 handle. I mean, we got close. We didn't get close enough. I think we'll get another shot at it intraday. By the way, do I have to get it on a closing, or can it just touch 10.99 for me?
I'll allow the intraday move.
You'll allow the intraday.
Yeah. Why not?
You're going to give me a chance. I appreciate that.
Well, remember, I just have to touch 6,000, so I think it's fair enough, right? I mean,
and look, I think that'll happen. But that's I'm on the other side of that one. Yeah, I mean, what did we hit the low here of the year? 11.5 was the low where we touched on the VIX. We're not there now, so maybe a little sideways action may do it. A little slowdown here, but we're going into earnings. Doubtful that the volatility comes down. It could just be an earnings thing as well, Derek.
Oh, there you go. Yeah, no, we're getting into earnings season. It's, the political stuff is there's always a reason to worry. And there's always a reason not to invest, which is why we buy, we hedge. I mean, it's the core thing we do. We do a lot of other stuff, but it's sort of the core thing we do. And I think about we have 87 people were afraid to invest, and a lot of them missed, the market that 87, actually, the market ended up positive for the year. People still have the memory of 2008, 2009. They stayed in cash for a long time. And then I think the volatility of 2020 and the inflation kept a lot of people out. We don't know when market's going to go up or down. There's always a reason, though, geopolitically. Bank of America just recently did a survey, Jay, and they asked people, what's your number one concern? 2024 U.S. elections was the number one investor concern, followed by geopolitical risk and U.S. fiscal policy. This is like, hey, what's your biggest concern? Well, if I covered up 2024 on this survey, U.S. elections, geopolitical risk, U.S. fiscal policy, recession, real estate, inflation, debt, stagflation, China, put in a different country, trade war, rising interest rates. Like, there's always stuff that people are worried about. And if you go back and you say, what was people worried about and what happened? Remember, a lot of stuff has happened in the world and the market just hit another all-time high. So I don't know. I mean, this is why we buy and we hedge. I think people get a little too caught up in we'd get many more listeners, Jay, if we just scared the heck out of people every week.
Sure. We gave the reason why you should sell, of course, why you should go to cash now, why you should take a bearish position. I mean, it's the, the clickbait, right? It's the scare people into following you because you've got something that'll, corroborate their fears. But the answer is much more boring, than that, historically, right? Markets tend to go up. Half the time, markets are up 15% or more in a single year through all of those fears that you just talked about. But if you want to take some of the risk off, yes, have some protection on. That's when you use a firm like ours. By the way, Derek, I want to congratulate you on your recent title change. You are now the CIO of Zega Investments. So I wanted to congratulate you on that on the podcast.
Thank you, Jay. Appreciate it. Yeah, no, that's
well earned, well deserved.
That's Chief Investment Officer, not like Chief.
Not the Chief Information Officer. That is true. Right. Yeah, yes, in our business, we call that the CTO, not the CIO. Yes, you're the Chief Investment Officer for Zega Investments. So congratulations.
There you go.
Yes. So if you like what Derek says, he's making investment decisions these days for Zega Investments. There you go.
Well, and if you don't like what I say, you should still let us hedge for you. So
there you go.
Yeah. Only 5 stars. We only want that. All right. So I mentioned I've been recommending The Bear. Have you gotten through season 3 yet?
I'm it's like one of those shows. So I'm not through it is the answer. And the reason why is it's one of those shows that everybody in my household likes to watch it. Well, guess what? For all of us to be together at one time, it just doesn't happen. So I'm just going to pull the ripcord and watch it and let everybody else catch up to me because I've been waiting for a while now to get through it. I love The Bear, of course.
Yeah, I'll reserve. I said last week that I think season 2 is the best, but season 3 it's good. It's good.
It's a very different flavor, pun intended, season 1 versus season 2. If you ever worked in the restaurant industry, you know the stress of what season 1 showed you. Season 2 seemed to make it much more posh and talk about the excellence of food preparation and how hard it is to actually get these things accurate. So get these things right. So it sounds like you like that, Derek. I mean, do you ever work in a kitchen?
Yes, no, I have. No, what I liked about season 2, though, like the Christmas episode was some of the best acted
There you
TV.
go.
It's
Absolutely.
frantic, absolutely frantic. But my favorite was the Richie. I don't want to ruin for the audience, but the Richie episode titled Spoons was my favorite episode.
I mean, real good transformation of that character on that episode, for sure.
So I don't want to ruin it for people, but they should watch it.
All right, cousin, don't ruin it.
Yep. Some of you will get that on the way home. Any other recommendations, Jay?
Let's see. I'm watching The Boys on Prime. If you haven't watched that, I think this is a newer season we're going through now.
Is that The Boys in the Boat?
No, just called The Boys. It's a dark take on what if, superheroes were actually more like humans and had human characteristics instead of being these idealistic people. And it turns out the superhero with the most powers exerts his power because he feels like it. And he's a total narcissist. So, yeah, if you haven't watched The Boys, Derek, I'm surprised we haven't talked about it. Maybe not one yet for your son.
Well, I'm not into the superhero movies, though.
Which is why you will like this.
Okay. So it's like if they did an anti-crypto movie, this is like an anti-superhero one?
It's anti-superhero, yes.
Okay. All right. I'm writing it down. Somebody told me I should start watching Dexter, which...
Oh, I've watched all Dexters. You should.
Good? Okay.
Good. Now, listen, don't get mad at the finale because they end up, having a follow-up season a decade later. I'm not sure if they'll have another one. Probably can't the way that it ended, but you never know. But Dexter is now on, I think, Paramount Plus. I think all of those. Is it on Netflix also?
Yeah.
You should watch it. You talk about another dark show. Yes, you should watch that. Well, you somehow love the serial killer.
All right. Well, yeah. No, I mean, I know the premise, so it's I understand that's coming my way. No, I'm glad to hear they do another one because when I watched Breaking Bad, a lot of people who were fans of the show didn't realize this. Breaking Bad had tons of episodes, and I think it was 3 or 4 years later they did a follow-up, just a standalone movie, and you get great explanation of what happens to the characters. So it's called El Camino, and then Breaking Bad is the series.
What are the top rank shows of all time? Breaking Bad.
Yeah, it took me a while to get into it, but once I did, I was like, all right, now I see what everyone else is.
I've tried 3 times. I can't get over the hump.
You have to get through some of the middle seasons. The
middle seasons? I can't get through the first season.
The payoff is that they landed the plane on that one for sure.
All right.
So, all right. And then apparently the New York Giants, Hard Knocks is already out.
Yep, a couple episodes out already. I like to let those queue up a little bit and I'll watch them, but I think there's some Saquon stuff in there, so I'm definitely gonna watch that.
I want an explanation of how we didn't sign Saquon and really we didn't draft a quarterback. I need explanations on that, so I may have to watch that. Maybe they'll explain it to me in a way that I understand, but I don't understand it yet.
I think they do. I think that's why they did the show, whether you believe it or not.
All right, Jay, let's leave it there. We'll come back next week and you can find out next week how wrong we were this week with everything we talked about.
Absolutely.
All right, send us emails, 5 stars, all that stuff. See you, everyone.
Bye.